With the completion of the recent bank reporting season, we've seen the banks have one of their better reporting periods for some time, with the good outweighing the bad. So what do we like? Well, firstly, lower bad debts. We've seen the end of the shortest bad debt cycle in over 20 years. In fact, the banks have had to write back some of those bad debts they've previously provided for. So that's been helped by the great bounce back in the economy. And importantly for investors, owning banks during a recession is not great, but now they're more reasonable investments. Secondly is the strong balance sheet. So we've had banks build up excess capital over the last year with the cessation of dividends and also raising capital. So that's put them in a very strong position going forward. Thirdly, lower remediation costs. So post the Royal Commission, there are a lot of remediation costs and payouts. Those costs are coming to an end and are really not material. So that's placed them in a really good position going forward on that cost front. The fourth thing is improved efficiencies of processing. So I've seen them slim down to their core businesses, selling non-core assets and focusing on improving how they operate the business. And that really places them in a positive position. And fifthly, lower funding costs. So help from the government has really lowered those costs over the last year and also lower deposit rates. And that's really stabilised margins and put them in a very strong position when rates rise. The best thing that's happened over the reporting period is a resumption of dividends, and the likely return to 2019 levels looks within reach over the next couple of years. So what didn't we like out of the bank reporting season? Well, there's two things mainly. Firstly, and most importantly, is lack of growth. The bank's balance sheets didn't grow during the period, and that's a worry going forward. They've lost market share to the smaller banks and some offshore competitors, although CBA and Macquarie have done pretty well with that. So that's something to watch going forward, although there is the prospect of better growth from here on. The second thing, which is not a big issue, but lower trading income was disappointing, but that's coming off a very strong base from the last reporting period. So that's less worrisome, but still of concern. So in summary, the sector looks a much better place for investors today than it did a year ago. And now there's a prospect of further gains over the next year. We have the prospect of growing dividends and some earnings growth. In addition, we have the prospect of capital returns to shareholders as well. In terms of quality, CBA is the standout across most metrics, but for us offers the least upside as an investment as it is very expensive. For us at EQT, NAB looks the best value for money, having spent the last 2 years re-engineering its loan systems and processes, but also having greater exposure to small business and very strong management. Overall, it's been a good result across the board, mostly driven by lower bad debts.